Welcome to Morning Joe with me, Jim. Lighting's terrible, but anyway, we're outside today. It's kind of a nice day. That's why I love the Low Country. It feels like spring when it's not even close. Hey, I wanted to talk today. So we've talked about the New Year's resolutions. Whether it's to buy a home, buy your investment property, etc., and the drawbacks to accomplishing that. Right? Sometimes it's credit, sometimes it's down payment. And today I want to talk about down payment, right? There's a loan out there that does not get the credit it deserves, or it doesn't get as much. I don't know the word I'm looking for. Oh, I have to preview this, and and that's called the USDA Rural Housing Loan, right? So let's go preview this and take a look at it. So I compared it to FHA. So a lot of people think of FHA as the first time homebuyers loan. And I get it because it's a low down payment. It's very easy to qualify for generally with a lower credit score, with a lower down payment, etc. Not so much lower anymore because conventional is 3% down. And I didn't even put that on here, but that's also a great loan with no geographic restrictions. However, if you're looking what's considered rural, right? If you're looking over in Monk's Corner or up in Ridgeville or something like that for a home, you might want to go with USDA. So here's USDA, here's FHA. I put both as a $320,000 purchase price, right? And you'll notice that the loan amount is higher, right? And it's higher than 320. And that's because USDA and FHA both have what they call upfront mortgage insurance premium. So kind of like VA. VA has a funding. VA has no mortgage insurance PMI, but it does have that upfront funding fee that gets added to the balance of the mortgage. Well, FHA and USDA both have the same thing, or something very similar anyway. It's a percentage that gets added to the balance of the mortgage. So your mortgage is 100% financing, but your mortgage amount is higher, and that's because it's like half of your PMI gets added to the balance, and then the other half gets paid monthly. However, this is 1%. It's 1% of the balance of the loan amount gets added to the balance. FHA is 1.75%. So 1% versus 1.75% versus VA, might as well throw that in, is 2.3% on a first use. And so therefore your payment, I include taxes and insurance, and so it's going to be about that on 320. Now your cash to close. Let's highlight that as well. So the cash to close here does not include a down payment because there is no down payment on USDA. However, on FHA, it's 3.5% of the purchase price. So that's all baked into this cash to close number. Here's what I want to highlight. If you negotiate that the sellers pay, say, $5,000 toward closing costs, then your cash to close is not $5,934, it's $934, right? So if you negotiate that the sellers pay $5,500 toward closing costs, well, you might need $400 and some dollars to bring to closing. So it's very easy to get into a USDA home like that. Here's the difference as well. So USDA is 100% financing, FHA is 3.5% down, it's 96.5% financing, right? You need 3.5% down for FHA, so you're putting a down payment. You would think, all things being equal, FHA would be a lower payment, but it's not. And the reason it's not is also your monthly mortgage insurance, your PMI, right, is less on USDA than it is for FHA. It's 0.85% per year of the loan amount. You don't have to remember this. This is just something but it's 0.85% for FHA. For USDA, it's 0.35% of the loan amount per year divided by 12. And so you can see over the first 5 years of owning a home, again, all things being equal, purchase price, etc., you're about almost $7,000 cheaper to own with USDA than FHA. Now, why don't more people go with a USDA loan? Well, really simple. Two things. The property has to be considered rural to qualify, right? So you have to have a rural property, and there's maps and stuff we can look it up. It's very easy to look up. In fact, if you want to Google it, it's USDA eligibility. First thing that comes up is your map. And there's income limits. So household income limits. So even if there's a husband and wife living in the household and only one wants to be on the loan, USDA takes into account the entire income of the entire household, right? Both husband and wife's income. If it's over the limit, it doesn't qualify. So I hope that helps. USDA is really, really a great loan to get into a home, especially if you're a first-time buyer. But there's limits. You have to be looking in what's considered a rural area, and you have to be under the income limits. So we can look both those up, and I can do that for you, and I'm happy to do that. If I can help you get pre-approved, let me know. Happy to do so, and have an awesome day. We will talk to you soon.